Yeah, so John gave me a Georgetown T-shirt yesterday, and that was my reward for 4 years of my parents' tuition. And after he gave me the Georgetown T-shirt, he leaned over and said, "Oh, by the way, you're actually not talking to a room full of econometricians. You're talking to a room full of practitioners." So that's sort of a test of my Georgetown education to see if I could do this stuff on the fly. So some of these slides I'm going to be flying through, but I'll try to keep it relevant. I'm also going to walk and talk. Once you get tenure at a university, there are really very few controls on your behavior. But one of the controls is that, at least in our department, at the end of the year, the graduate students do a skit about the faculty. And when they did the skit on me a couple of years ago, they actually had 2 students, one standing behind the other, and they had 4 arms waving the whole time. It was hard enough for me to have to admit that, but they had one of the arms writing stuff on the board and then the other arm erasing it right away as the person walked around. So I'll try to. There's no way I could stand behind here and do this. But I'll try to stay calm. So what I am talking about is the derived demand for rail and truck, and I'm calling this now the price effects in truck competitive railroad freight markets. So this is kind of a series of footnotes to what David was talking about before, but without externality taxes. A lot has been said about the Staggers Act, and there's been a lot of analysis. This picture actually kind of says it for me. This industry really started in the 19th century. In the East, it was built heavily to move people and manufactured goods in the late 19th century. By the middle of the 20th century, there were highways to do all of that. All right, so what you ended up with in the East was sparse traffic on a very dense network. Meanwhile, by the middle of the 20th century, the things that freight railroads carried efficiently, were coming out of the West: coal, chemicals, lumber, agricultural products. And so there you had dense traffic on a sparse network, which is a better thing to have if you're running a railroad. And so the railroads in the West were more or less healthy. The railroads in the East were either bankrupt or in trouble, okay? And you can really think of the Staggers Act then as recognizing a fact, which, by the way, John showed us again may be happening, and where there's a need for rationalization. And what Staggers, I think, if you boil down all of the different provisions in Staggers, it really said, the industry itself is capable of doing that. Let's give the industry the freedom it needs to do that. And so the rationalization took place as a result of following the Staggers. Okay, so that raises some questions. I say here the future of multi-product railroad freight markets. I really should not have said that. All I really want to identify is the status, okay? And really identify what are the competitive in the sense of competition between truck and rail markets where railroads are working, competing effectively. And then a second question is, what's the degree of competition between railroads and trucks in these markets? And then third, the economic implications for the carriers, and then also, really important, for the industries that they serve. Fourth, broader, and we heard about some of the broader implications in the last talk. I don't really cover those in this presentation, but they're there. And I think this kind of gives you some of the methodology you need to get at this fourth question. Okay, so in the movie industry, this would be called product placement. This was my way of figuring out how to motivate this talk by bringing in something from Minnesota. And actually, this is Steve Dittmeyer, who's sitting over there, sent me this slide last year. And so this is a small railroad yard at a small town called Staples, Minnesota, on August 14, 2014. And the point is that it illustrates, among other things, what are the railroad markets, okay? And I'm now about to show you the sort of exhaust my depth of knowledge of the real railroad industry. But so on the far left, that's an intermodal train, so that's carrying lots of stuff, and then a coal train, and then a multi-rack train, which is carrying finished automobiles, and then a grain train, those are covered hoppers, and then another multi-rack covering more finished automobiles, okay? And then we've got 3 more oil trains, okay? So they're all carrying oil from the west to the east. And as Steve pointed out to me, they're all waiting to get onto a single track going east, and then they're all going to have to come back. Okay, so this was the situation that I'm sure many of you heard about, whether you're in government or not, last year. That's not the same this year, as John would point out. These were kind of the salad days, okay? All right, but it just says, one, that there are a number of markets. Those are important, and those different markets are important to the railroads. It's not just coal from which they get their margins. All of those different kinds of commodities generate significant margins for the railroads. And then maybe it also illustrates external effects, because if you notice, next to that yard is a highway that's got nothing on it, all right? And you wouldn't want to take all of that stuff out of that yard and put it into trucks and put it on the railroad, all right? End of my paid political announcement from Minnesota. Okay, so the question then is, how has this industry evolved, okay? To what extent do we have competition? One, these markets matter, and two, to what extent do we have these competitive markets, especially, and John explained this to us this morning, if coal is beginning the amount of coal is being truncated. All right, so what I found is a paper which was published in 1980 by the great Nan Friedlander, who was professor of economics and then dean of social science at MIT, who was a lifetime student of the rail industry, actually served on the board of Conrail, and did a number of studies prior to 1980 which were helpful in making the case for deregulation and for the Staggers Act, along with the great John Mayer. This is a paper that Nan and Richard Spady published in the Review of Economics and Statistics. It was based on a cost function. From that cost function, they derived industry-level demands for rail and truck. Industry demands in the sense of how much did each industry spend on rail and truck given variations in the rates that rail and truck were charging that they observed. The data was a cross-section of 96 three-digit stick manufacturing industries. That's standard transportation commodity codes. Okay, so all we want to get from this paper, so what I show here, and if you can't see these numbers, and I can see them only because I'm standing here, you do have handouts. And so maybe to focus on the third and fourth columns in that slide there, which is truck own price and truck rail cross price. So an elasticity basically says if I increase the price a certain percent, what's going to happen to the quantity, all right? And so if we look at that truck own price, 10% is too much, but let's think of it that way. If based on this, the sensitivities that Friedlander and Spady observed in their statistical analysis, if truck prices in food products went up by 10%, then truck movement, basically, truck movements would go down, all right? So that's just industries contracting their output, all right? Wood products, a higher elasticity there. Paper prices go up 10%, truck rates go up 10%, truck quantities go down by about 10%, and so on. So those are not unreasonable elasticities to observe. The column of interest is the next column in red, which is truck rail cross price. So the experiment there is if the rail price goes up by even 1%, all right, let's say, what then would be the change in truck quantities moved? You would expect as the rail price goes up for the truck quantity to go up if it's a competitive market. Not much happens in the food market to move food products or in wood. In fact, those are negative, which just means they're not finding anything in the data. These are not even significant estimates that they're getting. Paper, nothing. Stone and glass, and so on, all right? So essentially, and if you look at rail truck, which is just running the experiment the other way, okay, you just don't see much action in 1972, all right? So a question you would ask is, have things changed? Obviously, we've had staggers. Staggers allowed the railroads to rationalize, okay, to get out of areas where they don't want to be, to sign contracts with shippers, and to charge a much broader and more flexible set of prices, okay? Not just that, though. So not just the change in the regulatory framework, but technological change, okay, that we heard about earlier today, all right? And maybe on the same scale almost as getting the standardization of the rail distances, which was intermodal. Okay, so this is a chart, and the easily available data starts in 1978, and this is a chart that shows car loadings. Okay, car loads originated between 1978 and 2012. All right, so right before Staggers and then after Staggers, and the more or less straight lines there are wood products, paper products, chemicals, motor vehicles. Okay, which are not really moving a lot in terms of car loadings, all right? The one that really moves is intermodal, okay? So this is a new, and to some extent the change in the technology was related to Staggers. Railroads had the revenue to invest in intermodal, okay, and to sign agreements with shippers. Okay, but it was also the technology, and also what was happening with the ocean shipping industry. But basically, you have this very, very dramatic introduction of intermodal transportation. And the question is then, one question, does that then let railroads compete effectively with trucks in markets where they didn't compete so effectively before? So to get at that, my grad student, Ishai Hadash, and I looked for new data, and what we found was what's called a panel, which is basically the same kind of cross-section that Friedlander and Spady used, but we had 3 years. Okay, so we went to the economic census for 97, 2002, and 2007, and we found industries for which we had movement data, all right? And then most importantly, again, this was Friedlander's approach, we had from NAICS, the North American Industrial Classification System reports that the Department of Commerce puts out, a lot of information about these industries. What do they spend? How many employees do they have? What's the level of capital? What kind of material stocks do they have? So we put together the movement data and the industry data, as Friedlander did, all right, and redid the estimate. We used a slightly different kind of cost model for what was essentially a technical reason, which is the new data doesn't give you expenditures, but we did have the quantities of movement. So we did have truck ton miles and rail ton miles, and this generalized McFadden function let us do that. All right, that's a detail. So notice how fast I went through that one, John. Pretty good. And John probably wants me to go through this one really fast, too, and I would like to go through it fast. The only thing I want to say is that, so those W's there are prices, and those are basically the, and David mentioned before, it's the relative prices that matter. So we're picking up relative prices of rail, relative price of truck, and then also, in this case, labor prices. Because what this model tries to do is say, not only can a shipper substitute truck for rail or rail for truck, but they can say, look, both of these are expensive or both are congested, so we're going to put in new distribution facilities, et cetera. So this kind of analysis kind of gives you a somewhat broader perspective than the traditional logit models that people use to model transportation demand. All right, the other technical thing I wanted to say is that those last two equations there, WR is the price for rail, but we're putting in length of haul into the model. And that's a way, and this again is what Friedlander and Spady did, and that's a way of trying to pick up the quality of service. It doesn't do it perfectly, but it kind of controls for that. Okay, so to the results. We don't need to talk about the parameters because I want to take them and use those to get to the elasticities. Okay, so now let's just really go. So if you look at what is now the fourth column, because I listed the different NAICS industries, truck own price estimates really aren't very different from Friedlander's, okay? And you wouldn't expect that market essentially isn't that different, okay? But the truck rail cross prices are quite a bit different, okay? And now it says in effect that if rail increases its price by 10%, let's say, well, let's say rail increases its prices by 5%, then truck traffic, okay, is going to go up by 5%. So that says something's happening, right? Truck traffic is responding to changes in rail prices and vice versa, okay? And that's true in food products, in wood products, in paper, in minerals, in fabricated metal, okay, significantly. And actually the 0.6 is not tiny, all right? Even that's a significant move when you think of the relative size of the truck market here. That rail can, if they increase their prices by 10%, that's going to have that effect on truck quantities. Okay. So, and I'll map those out a little bit more later. And that just is a little slide comparing the 72 estimates that Friedlander, and essentially using the same kind of model and the same basic data, okay, except 20, 30 years later. All right, so to kind of get, to get to the bottom line, well, not all is lost. All right, so there were really two kinds of studies that people were doing about 5 or 10 years ago. One was the AASHTO study where they said transportation is growing with GDP. We're going to have congestion on all the networks, and therefore how much stuff could go onto the rail network. More recently, the DOT in its wisdom said we need to rethink again the question of what's going to happen if truck size and weight restrictions are changed. And they said after, 2 years, we don't know enough to say that. But basically, that's the experiment that we're doing here. So I'm saying, let's say there were a significant loosening of truck size and weight restrictions or lower fuel prices. Now, these are going to be bigger shifts than the ones that David talked about last time, okay? Because I'm just going to say and this is actually when the DOT did its 2000 more extensive truck size and weight study, they projected that significant changes in TS&W would lead to about a 10% reduction in truck costs, which given the structure of the industry would translate to 10% reduction in rates or prices. And so that was the experiment I did, just using the elasticities that we calculated. Okay, and so notice, and these are not, again, totally that far from the estimates you saw earlier. It says that in this case, again, truck rates are going up. I'm sorry, truck rates are going down. So in this case, some of the traffic that's on the rail network is going to go to the highway system. And it was about 5% of the total market went to, food market went away from rail and over to truck. The lumber estimate is too big and I don't believe it. Paper was about 5%, chemicals 3%, and down there finished automobiles, which were those multi-rack cars you saw, about 2%. The number in parentheses says, yeah, but the rail share Okay, so rail picks up 5%, but it only had 21% of the market. So in effect, it's losing 19% of its food market. All right, so a significant effect from truck size and weight changes, according to these estimates. And then if you go the other way and get an even crazier looking slide, if you go the other way and say what would happen with a significant increase in fuel prices or road congestion or imposing a tax for externalities, what would happen? And again, so this now says a 10% increase in the relative truck price, i.e. relative to rail, then that would give you about a 6% bump in rail traffic for food, about a 5% bump for paper, and you guys can probably read it better than I can, a similar bump for, not quite as big for chemicals, and then about a 5% increase in rail traffic for autos, okay? I should have said one other thing, that back to the TS&W projection, that what the numbers showed, and this John Gray, and John certifies that these were totally objective estimates that he did, that amount of diversion from rail would translate into 3 billion added heavy truck miles annually, okay? So I'm now, and I'm actually finished, okay? So that's how far we got. It's clear, I think, from the statistical evidence that there has an increased degree, and we can see it if you look out the window, increased degree of railroad truck competition since 1972. That says that railroads do have the potential to divert freight from the highways, all right? Not a huge amount, right? We're not going to see 300-mile long intermodal trains on the rail network, but there could be significant diversion. At the same time, the converse effect is true, that if you do have a loosening, had there been a loosening of truck size and weight, which I guess we don't think is likely now, that then would have a significant effect on the rail industry. And then finally, and this is without getting into all the technicalities of it, I think we showed that this approach that Nan Friedlander and Dick Spady did in 1980 still makes sense. Again, logit models are very good at looking at the existing. What a logit model tries to do is to say, here are the characteristics of a given commodity. As those characteristics change, how does the probability of something going by rail or by truck change? But it's the characteristics of the commodities that those models look at. What Friedlander looked at here are industry characteristics. Okay, and I think to really understand this industry, in fact, and I want to thank Jeff and John that two things have come out today which to me are somewhat different. We've looked at the history of the industry in different ways, and I think that's very important. All right, this thing wasn't invented from a blank sheet of paper, and none of the problems we deal with are with a blank sheet of paper. And secondly, looking at contracts, for example, we're trying to understand the industry through the other industries that it serves, all right? And again, I think if you think back to the history of deregulation, it was really the shippers in 1979 and 1980 who went to Congress and said, we could work best if we can work directly with the railroad industry. I think what that says to us as economists is we can understand this industry best if we understand this rail industry the best if we understand the industries that it works with. So that's, yeah.
John Wetmore, pedestrians.org. About how long do you figure it takes to reach an equilibrium if you make a change like this? And how long does a transitory change have to last before you see a major shift in the industry?
Yeah, and that's why when I said this is not really about the future, because I think we are at a, whatever the equilibrium that you're going to get to as a result of the Staggers Act changes is here, okay? Maybe it was here a couple of years ago. I don't know personally what the future of the shale is. I think it's going to be not what it was last year, but it's going to be significant. So I think we are at a new equilibrium now. Now comes coal, all right, and the question of how effectively railroads compete in these other markets, all right. To me, and this kind of came up this morning, the other question, though, is that if you think of Staggers as the policy response to the 1980 need for rationalization, what's the policy response now? I mean, it's a little bit like what they say about we've used up all the monetary policy with the macroeconomy, okay? Have we used up all of the policy alternatives for the rail industry? Now what can be done? And I think that's a really interesting question.
Hi, Kevin Nielsen Brattle. I have to ask a little bit of a techie question here. In your econometrics, what's the unit of observation and what kind of sample sizes were you working with?
So unit of observation are individual industries. So we started with about 50 NAICS industries, but each of those industries for 3 years. And then we did the same kind of filtering that Friedlander did, which was to say, only in cases where rail traffic is greater than 5% do we even look at the market. And that got us down to about 30 industries. And that's the other real dollars for all the indices for the wages, real dollars for the expenditures, and then value of output for the output of the industry, and then ton miles for truck and for rail.
Thanks.
Yeah. Yes.
Hi, Jack Ventura. It seems to me the most dramatic results I'm seeing in your paper is the cross elasticities change from 72 to 2002, indicating, as you say over there, increased degree of rail truck competition. But can you explain, I don't know if I missed it, but the underlying reason for that? Could it be that because of truck deregulation, that the actual margins on truck are much lower, and so an increase in rail rates would shift more traffic than it would have in the past when trucks were regulated?
So
I mean, what underlying reason would you say that?
I never really tried to estimate the effect of motor carrier deregulation. Clearly, it's something that's going on, all right? Although I would think that the effect of motor carrier deregulation was to push truck prices down to very close to marginal cost, okay? What I think is the main point is that, all right, which is that, now, I mean, I'm sort of looking at the result and saying that's the cause, but I think that is also the cause. I mean, I think the fact that you have that kind of intermodal technology available, which you didn't have, all right? And obviously, Staggers did not invent the container, but I think people in the industry would argue that Staggers gave them the degrees of freedom plus the investment money to make intermodal work.
Yeah, I thought of that, but the thing is that you've got these product categories that don't jibe with intermodal. You have food products might, but wood products, chemicals, that's a lower elasticity.
No, so those are ones that did not significantly change. Now, some of these things actually do move in containers. I mean, you can tease out from the rail data intermodal ton miles, both as general freight and also as by categories. Some chemicals, some auto parts, for example, et cetera, et cetera. I mean, in a way, that graph says that the competitive part was the intermodal containers, and a lot of those things. I mean, a lot of that stuff then can move by container. Yeah.
Gerard.
Yep.
On your concluding observation slide, to that? Top,
All the way.
all the way. Top bullet. Is that top bullet actually correct? Because there's been another change. Railroads and trucking companies don't really compete much anymore. Trucking companies are customers of railroads, and in fact, they're the largest category of shippers on the railroad now, and they are the client, or the customer, if you will. And so it's changed a relationship there. The competition is whether the vehicle goes on a roadway or a railroad, but the trucking company remains in charge of it even when it's moving by train.
Yeah, and we've talked about, I think that's true, although anything that's going by container could stay on the highway. Okay, so we may not actually see a negotiation, all right? We may not see bidding, okay? But if the railroad price is too high, it's going to stay in the truck.
Right.
So I would call that a form of competition.
Right, but again, it's
kind of the difference between the quantity demanded.
The shipper doesn't see this. It's the trucking company that makes that decision which way it goes.
Right, but I think that then becomes somewhat semantic in the sense that the railroad still has to compete.
Oh, absolutely.
With
the service and the price.
The trucks of the trucking company, exactly.
Right.
Yeah, yeah. So
but J.B. Hunt throws a lot
that's
on.
a good point. Yeah.
The biggest shipper, single shipper on rail now is UPS.
Is UPS, exactly. Yeah, exactly.
With trucks.
Yeah. John, do you want to? Yeah, okay.
So, George, can I, this is Ken Boyer from Michigan State.
Oh, they are, Ken.
Can I inquire, so Friedlander and Spady had these results which seemed counterintuitive at the time, where the cross-elasticities of demand were virtually zero with very high elasticities for the own mode, which said that essentially whenever a rail raised its prices, you got a shrinking towards the origins or towards the destinations, or there are tremendous effects, but on the amount shipped, but virtually nothing in the way of mode shifting for either mode.
Yeah, exactly.
And so now you have, it seems to me, you have results which are closer to what we intuitively think is correct. That is to say that there is some response of one mode to the prices of another. My question is, do you also have the assumption that there is some, in the final two columns here, that there's some captive truck shipment, that is to say, some short shipments by truck, which would not shift to rail, but virtually all shipments of rail could shift to truck, which would say that the cross-elasticity of demand from rail to truck would be higher than the cross-elasticity in the other way. So the question is, on these last two columns that you have in your results, which is which? Which is the elasticity?
I think we made too broad. I mean, you're right. This is we're making sort of too broad an assumption, which is that price can do everything. We do try to control for that with length of haul, but all length of haul really picks up. And actually, if you look at the parameter results, they make sense in terms of length of haul being a negative effect in a generalized price for one mode, positive effect for the other. But when we do the elasticities, we don't then restrict the movements for, I mean, to really do it right or do it even more precisely, we should restrict the mileage within which the competition actually takes place, and we don't do that. That's true. I think the other thing, though, that may explain Nan and Dick's results is that it's just the cross-section, so it doesn't give anybody any time to react, and here we had 10 years to let them react, and so that's probably what does happen then, that somebody has time to, you know, as you saw with your lumber shipper earlier, you know, they've got time to think about, do they use this thing now or do they build a new rail siding? And we don't specifically model that in our, put that into our model, but we allow for that to happen over time. So, yeah. Yes.
Paul Hitchcock, CSX. Let me just offer some totally qualitative, off-the-cuff thoughts on why you see what you see in the first bullet point, beginning in 1972. In 1972, the concept of international container shipping was pretty small. In 72, the railroads were still regulated. It was in the late 70s, and I forget the date, that the ICC exempted piggyback, now called intermodal traffic, from regulation, which opened the door to very, very aggressive new marketing ideas by the railroads in that area. In the early 1980s, boxcars were exempted from regulation, and as a consequence, the railroads had to figure out on a carload basis how to compete with trucks and to take advantage of that opportunity, which they did. In the meantime, what you almost certainly found, and again, this is totally without facts behind it, but I'm sure you must have found in growing investment in containers. At some point in there, shippers, the railroads and third parties began getting into the domestic intermodal business as opposed to looking at international shipping containers as an import or export kind of a service that they were offering. So you began to get more investment in domestic containers, more investment in those kinds of services. Then the railroads over that time period have almost certainly invested heavily in terminal facilities so that they could offer new services from city to city. And you know, very recently, last 5 years or so, we've begun to see this concept, at least in one location on CSX, where there's a kind of a switching yard, as in our Northwest Ohio, so you don't have to run an entire train from one city to the next city and unload. You can take an entire train, take it somewhere, and break it apart. So you're seeing innovation, you're seeing increased investment, you're seeing more players in this marketplace. And I think I would just offer those as thoughts. All of them could be investigated qualitatively, I'm sure. But from a qualitative standpoint, those are worth thinking about.
And it goes, maybe I want to be more cautious about my answer that we've gotten to the equilibrium then. And it may well be that we don't yet know what the equilibrium is in containers, right? I mean, that really, that technology hasn't been fully exploited as an effect.
Well, you're going to see railroads, you'll see one railroad investing very heavily in intermodal going forward, and an increased emphasis on intermodal as we've lost coal traffic.
Right.
That means capital investment. Sorry. Don't mean to talk too much.
We're having a very interesting conversation here.
You're going to see at least one railroad right here, CSX, investing more and more in the intermodal business, looking to that as a growth industry to replace much of the coal traffic that's been lost. And I'm sure that we'll be seeing investment decisions that would have been made on a coal traffic or a bulk traffic basis to support that kind of traffic, now being shifted over into intermodal.
Okay, one more question from Bob McCullough.
I'll be real quick.
Again, this draws attention back to some of the things that we raised at the top of the day. If it is that the trucks will be able to take advantage of driverless vehicles, and if they will not have to pay higher user charges per the CBO report, the railroads are in a world of hurt in trying to capture this commodity or this miscellaneous traffic, I think. And hence, the sunk cost problems of the coal traffic that's going to go away will be even more devastating to that industry.
Okay, thank you.
Thanks.